Hi everybody, Anthony Fletcher. Thanks for showing up my channel today. I sure appreciate it. And if you get the chance when you're through watching this, please like or subscribe or even share these videos because a lot of people want to know a little bit more about mortgages, especially because they're thinking about buying in the near future. Today we're going to talk about non-traditional credit. And the reason why we want to talk about that is because there's a lot of people out there that think they can't buy a house because they don't have any credit established. Now there's three different types of credit. You got good credit, which is usually above, 640 or so. You got not so good credit, blemish credit below 640, between 640 and 580, and 500. And then you usually have no credit, which is people that have absolutely no credit on their credit report. Now, what is the credit score on the credit reports? Well, they go for anywhere between 350 and 850, okay? And actually 300 and 850. And 300 being the lowest and 850 being the highest. Now, when you look at a credit report, they are done by three different bureaus out there. There is a TransUnion report, an Equifax report, an Experian report. And when you go to get an application done by a lender, the lender is going to then pull what they call a tri-merge. It's a merge of all three of those reports. Okay, and then what they're going to do is they're going to key in your application information, and then it's going to generate that report from the credit reporting company. And they use the middle score from your credit report to determine type of loans and what rates and programs you're eligible for. So if they go and they pull that report on there and there's absolutely nothing, it'll show exactly what a client of mine today should like. And it said insufficient credit resources. So what do we do? Well, the way that we can get around that is the credit reporting companies allow us to create a non-traditional credit report based off of looking at 12 to 24 months worth of rent and three other different types of non-traditional credit sources. And they could be your utilities, including water, electric, your cable, your phone bill, your monthly payment for your homeowner's insurance, and even you can use your 401k savings and IRA deposits if you're doing that on a monthly basis. Doing that is actually considered a very good way of documenting monthly payments, paying yourself first. So they'll do that and then they'll grab all that information, and it's important for you to provide that to them and provide it all at one time. So rather than get them 3 months of this and 2 months of that and then 1 month of this and 2 months of that, they want all the information up front. Now, for example, if any of these bills are paid by a credit card, let's say if a family member's credit card or a significant other's credit card, well, those are considered paid items. So they need to come from a checking and savings account, some sort of accounts that has money in it, so that they show that they haven't just been passed on. They show that the actual payment has occurred. And you'll need to usually document that by getting 12 months worth of bank statements. So when it all comes from one bank statement and you get 12 months of it, that's an easy way of showing it. Okay, now let's show you the different types of programs that are available. Now, once the lender sends all that information, the credit bureau will usually give a credit score of about 640, which is average, a little bit below average, but it's good enough to get a loan through any of these, through FHA with as little as 3.5% down, USDA and VA with 0% down, and a conventional loan with as little as 10% down. Now, conventional loans go all the way up to 97% loan to value, which means you only have to put 3% down, but in this case, they'll allow you up to, so you still have to put 10% down. So in this case, if you can't have this much, maybe the FHA is the way to go. Now, a couple things you do need to remember though, and one, it can take more time. One, because you got to get all this documentation and then they got to submit it in to the credit company so they can create a credit score for you. And then the second one, it might mean the underwriter has to do manual underwriting. And that means to get you actually your approval, your pre-approval, that the underwriter will need to review everything that you have provided. But It is a great way in order to get a loan, especially in a time like right now where there are houses out there and not enough buyers. So you might get your chance to get at a house at a much better deal than normal. So there you go. All the information you need to know about traditional credit. I sure appreciate your time today. Thanks for tuning in my channel, and we'll see you again. Take care now. Bye.